Hey everybody, so it's Justin with the Peer Group, and this is my normal monthly market update. It's a little bit late this month. I did come on vacation, you can probably see that behind me. I thought it was a nice place to record a video. So let's talk about July's market report and exactly what's going on, and I'll reference back to some kind of San Diego specific stuff, or at least Southern California specific stuff. So we're moving into the second half of the year, and we're taking stock of how the market has fared so far. It's important to do that because it changes. Right now we're in a very connected period and things are changing rapidly. So the good news is that despite many gloomy forecasts from early January, our residential real estate market has returned more towards a typical seasonal trend as buyer demand has improved. Now, there's still a lot of challenges that remain for today's buyers and our would-be sellers, and there's hope and growth in this area. So with that in mind, let's take a look at the numbers. Now, as we delve into these numbers, it's important to remember that what a challenging 3 years, the last 3 years have been, and both on a personal health and economic front, but also from the standpoint of a real estate market, we've lived through some pretty unprecedented times. Now, it's been fraught with a lot of uncertainty, a lot of challenges, and now in the wake of the real estate market that was, by every stretch of the imagination, anything but average, we're here now, and we've seen in our prior monthly reports, we're going to refer to it as a unicorn period, unicorn years. So it's important to also remember that coming around to the new normal for many participants in this market, there is lingering uncertainty, some concern and perhaps confusion, especially as headlines have spent the better part of the last year calling for a housing recession, for an economic downturn, for a decline in prices. So with these three things in mind, it's important to remember that your confidence to make decisions has been shaken by all this doom and gloom, and it's being put out there by the mainstream media. So with that, I just want to highlight a quote from a gentleman called Vince Lombardi, who said so thoughtfully that confidence is contagious, but so is a lack of confidence. And I think as we go into the second half of the year, it's important to remember that understanding the markets, knowing the trends and the numbers is important, precisely because we want to be confident that we have the same understanding of the market, and you are confident making the right decisions for you. It has to make sense or it's not worth doing. So with that, let's look at some of the highlights of 2023 housing at mid-year. Now, you can see here, I'll run through it. Here's some good news. Number one, housing is normalizing. And after those two unprecedented unicorn years, we're seeing a normalization show up in demand. Now, we're seeing that normalization show up in prices. We're seeing that show up in a return of seasonality. And we're seeing the same trends pick up in spring, we build up towards the summer, and a slowdown during the fall and winter months of the year. Now, number two, we're also seeing prices rebounding. So by and large, we're seeing a market moving towards a new normal. However, along with these 2 points, we have to acknowledge there is a reality check aspect here. And that's kind of the kicker to the good news. So supply has been constrained. And as a result, we are seeing limited options when it comes to trading down, trading up, moving to our next home, in part because of this tight supply. Now, the higher mortgage numbers are making that difficult too. Not surprisingly, the number of new listings to market from a lot of homeowners who might be ready to move otherwise are still declining as we pass that mid-year point. External factors playing, external but internal to the industry, playing into what's going on. Excuse me. And as a result, because of this, we're just seeing prices, they're beginning to rise again, which puts, affordability as a primary challenge for many people that are wanting to participate in this year's market or who want to enter the market for the first time. Now, there is a silver lining to this reality check, and that's part of the outlook, and that we're seeing some good news. New construction's growing again, which is offering more options for buyers and sellers, and we'll take a closer look at what that means in turn. Now, that also means that we can expect a moderately active summer season. So let's take a closer look at the trends and especially the good news. So here we are, and we start with the demand side. We've seen buyer demand return to market after about 6 to 7 months in 2022, in which rising mortgage rates scared off a lot of people, and they're now, they pulled back. They didn't want to kind of buy and sell houses at that point. But in the second half of this year, Freddie Mac conducted a survey of buyers and sellers, and what they found was that, and this was done in May of this year, 18% of Americans said they were likely to buy a home in the next 6 months. It's a lot. That's a very high number. The normal turnover in the market, the normal share of people buying a home, it runs somewhere in the neighborhood of 8 to 10%. So as we are well north of that with those numbers, it's a clear indication that for a lot of Americans today, the desire to buy a home is very much on the front burner, in part because of life changes, circumstantial changes, and in many respects a period and a desire to move on from a very challenging pandemic period. So at the same time, 16% of Americans who own their home, who were surveyed in May, said they were likely to sell in the next 6 months. So those are some really solid indications of a market that is really returning to a more typical seasonal trend, but also importantly, returning towards a more active market, which means things are going to move again, and we're not going to have such a massive shortage. So on the demand side, it's also important to remember that today buyers come to market in a much stronger financial shape. Now, take a look at this. What you see here is from Experian, and it's the average credit score of a typical American consumer. Now, you see this going all the way back to 2010. 2022, the latest numbers show an average FICO score, and this is a FICO score of 714. Now, it's the highest level it's been for a while. I don't think it's ever been that high anywhere other than outside of this data parameter. And it's the same level for the last 2 years. So strong economy, strong saving rates, strong ability to weather financial challenges have meant that credit scores are at an all-time high. So just as importantly for the real estate market, Americans who apply for a mortgage and get approved have even higher FICO scores. So you see here from the New York Fed, as of the first quarter of this year, the median score of Americans taking over a mortgage or taking out a mortgage was 765. That's huge. It's higher than the typical American consumer, and it's a really good sign about housing market moving towards a new normal. So in addition, we've now had 10 months of mortgage rates moving mostly in a pretty well confined range, somewhere 6 to 7%. Now, this started back in October. Yes, we crested that 7% threshold a few times, but by and large, we've been confined in the range, which for all intents and purposes has become in a sense the new normal. And what we're being able to pick up from the buyer side is that many buyers across the country have accepted this. And I'm certainly seeing it here with conversations I'm having with buyers, that they're beginning to understand that this isn't going to go away anytime soon. And that it's not, although it has a massive effect, people are starting to get the 2% and the 3% rates that we were seeing during the unicorn years just aren't going to remain. So even though it's much harder than it was just a year ago and it's been accepted as a new normal, you're going to see, kind of these types of flyers advertising mortgage rates from the 80s. It seems like we were not doing so bad. And I actually have one here, I found it buried in the internet, and it's from July 85. I mean, look at those rates, 11.25%, and that's buying down 2 points. So you kind of get it. It's not the easiest time then, so it kind of puts it into perspective a little bit now. Now, instead of asking, can I afford to buy a house, what is really kind of the question that we should be talking about is, can we make the numbers work so I can purchase a home? And again, another sign of a normalizing market, and I think in that context, Lawrence Yun, forgive me if I'm butchering that, he's the chief economist at NAR. He's a very influential guy. He's got a lot of say. He understands a lot of what's going on in the market. I mean, this is what he does, right? He quotes something important, and mortgage rates are heavily influencing and have influenced the direction of home sales. And that means exactly what it says. The reason, home sales dropped down and everything else was because of the mortgage rates. Now, at the same time, it also highlights that relatively steady rates have led to several consecutive months of consistent home sales. And let's take a look at the numbers. So, what you see here are existing home sales from 2014 onwards until this year. And you see the green bars, the months of this year. So, as of May, the latest numbers, we were running at 4.3 million nationally. And that's an annualized pace of sales with a nice steady month-over-month increase. Yes, we are below the long-term average of 5.3 million, but at the same time, despite really gloomy predictions of a massive decline in sales and prices this year, what we're seeing is a much steadier market, which is chugging right along as many Americans are looking for their first or next home. So, importantly, we do need to look at home sales across price buckets. Buckets, brackets, however you want to refer to it. So what you see here are sales in a $0 to $100,000 range. You see in 100 to 250,000, 250 to 500, and so on. You see that the bulk of sales are taking place in that mid-range of the market, 250 to 5. Now for us here in Southern California, that's actually about 4 to 750, which is really somewhat more affordable part of the market. It gives us a good indication, and these numbers trend pretty much the same for us. The numbers on the bottom just kind of move. It does give a good sign of a normalization in our real estate market here in Southern California, and nationally that gives us a good picture as to what's going on. So at the same time, Mr. Lawrence Young, he points out, again, forgive me if I got it wrong, that while available inventory strongly impacts home sales, existing home sales and home sales activities are down sizably due to the current supply being roughly half the level of 2019. And when we take a look at the numbers, we quite quickly see that at a glance what Lawrence means here. When you look at the average month supply from 2011 to 2019 period, you see it's roughly about 5 months. That's the inventory you'd be expecting in a balanced market. Now today, and this is as of May 2023, we're at a 3-month supply. Now, it's an improvement from the unicorn years where you can see it was low, but at the same time, we're still quite a bit short of where we need to be in a balanced market. So, with the picture we're seeing here of the demand in the market, we're seeing a rebound and we're seeing some improvement in inventory availability. Now, if we take a quick look at the supply of existing homes listed, what we're seeing here is supply is improving but remains limited. Now, Realtor.com, they're telling us that there were 7.1% more homes for sale in June compared to the same time in 2022. That roughly translates into about 41,000 more homes. Now, this is, again, these figures are nationally, that are available to buy on a typical day during the month compared to 1 year ago. Now, at the same time, Realtor.com highlights that the inventory growth rate for homes continues to slow for the 4th month in a row. So, taking a picture of what that looks like, you can see active listings, and again, 2023, the months are highlighted in green. You can see those much higher than the same period during 2021 and 2022, which really is the good news. Buyers today have more options, and importantly, those homes that are coming and staying on market are spending longer, which gives us a little extra time to make decisions, to prepare offers, see homes. I do want to stress here that we're not going to just dawdle and kiss it off, doing it in a timely manner, and we are seeing listings in escrow but we're not seeing listings in escrow in 6 hours anymore. All in all, it's a really good development for markets, and at the same time, we're still below the levels we were in 2017 through 19. Now, when we look across the country geographically, you see where these active listings are growing, and you can see it's pretty widespread. The South, Midwest, Northwest, West. And as of June, we saw improvement in active listings compared to last year in the South, the Midwest, and the West regions. Now, the Northeast was the one region which showed a decline compared to last year, and yet when you compare it to the pre-pandemic period, you see that all 4 major regions of the country are still lagging in terms of number of property for sale. Now, San Diego County, I've got some data that specifically relates to us. This is the data for San Diego County, and you can see it fits our national trend. It's basically the same thing. So, Realtor.com highlights what is driving some of this, and the company actually says in the final week of June, we noticed that inventory actually declined on a year-over-year basis for the first time since last April. Now, this substantial slowdown was primarily given by fewer potential sellers opting to list their homes. Now, of course, we also have a cyclical issue. The market is now lapping the period of higher inventory growth that we did see last year. So, to put this into a visual format, you can see active listings, and you can see those that are blue lines on this bar graph, which have really been greater than new listings, the green bars in the graph. So for 30 months in a row, what's really keeping the market back is those new listings. It's homeowners ready to move forward but not feeling confident enough in the market to do so. So it's people who actually own homes who maybe want to change their situation, have a reason to move up, down, circumstantial changes. They're not doing that because they're still not feeling confident enough that they're going to be able to get something, similar or better that better caters to their needs. Now, Realtor.com points out that in June, the number of homes, newly listed for sale declined by 25.7% compared to the same time last year. Excuse me. And importantly, new listings remained almost 28% below pre-pandemic levels. Now, this was an interesting highlight from Realtor.com. The pace of new home listings year to date is 16.4% lower than in the first half of 2020, when the real estate market was still contending with pandemic era closures, restrictions and uncertainties. So what is being highlighted here is that the confidence level that homeowners have in today's market is even lower than what we faced during the toughest periods of the pandemic years. And that's the doom and gloom, that's the media, that's everything that's being kind of promulgated out there into the public by people that aren't necessarily, giving balanced information. And you can see from our data, and I want to reassure you that today's market is not the market that headlines in the media have talked about for the better part of 10 months. It's just not. And looking at the market and the numbers for the past 7 years, you can see every month plotted in terms of new listings. The dark blue line highlights this year. You see that new listings this year lag by quite a significant margin to the prior 6 years. And what's also worth noting is the return of seasonality. When you look at 17, 18, 19, the light blue and grey lines, you see the seasonal component of work, and you see new listings. The homeowners bringing homes to market starting in February, but especially March, April and May. Now, traditionally, homeowners bring homes to market in the spring, planning for a successful sale either in late spring or summer. And in tandem with that, we do see new listings begin to subside starting in June, and then moving through July, August, especially as the new academic year starts for a lot of public schools in September. August, September, October, November, we see the fall and winter months showing lower new listings. Now, we see this year, we see where June is, we're seeing that peak in May. Now, the new listings are beginning to retreat as of June. I expect the number to continue, and it mirrors the same seasonal trend. Now, of course, on the downside, that means we'll see fewer new listings potentially as we move through the rest of the year, but it's another indicator of what we're seeing with that return of seasonality. Now, what also stood out, and I think the president of the Federal Reserve Bank of Richmond, Tom Barkin, he captured it really well when he said, "I don't fully anticipate how much the moving interest rates, particularly over the last 12 months, would convince people not to put their houses on the market." This, I think, speaks so much to the fact that many homeowners are, in many ways, looking to trade up, or as they move into retirement, trade down. The surge in mortgage rates have presented them with additional challenges. And I get it, there's kind of a lot of question marks there, and there's a taste left over from, previously very low interest rates. And I just think it's not fair to compare those interest rates. You either got that deal or you didn't, and if you didn't, well, it's probably not coming again, so we just need to kind of come to terms with that. And I think in general, buyers are. So, one thing they're struggling with just as much as first-time buyers with finding a home, and second, they're looking many times at homes that might be higher priced and carry higher interest rates, which translates into much higher mortgage payments. Again, this is that problem. So we speak to that shortage of new listings. We took a look at the top 200 metros metro areas by population that Realtor.com provide inventory matrices for. And what we found out is in June, 99% of those top 200 saw new listings decreased compared to a year ago. Now, this in a sense captures how tight the market is for new listings and is now how significantly uncertain new homeowners feel about today's market. At the same time, there's a silver lining to this, and that's Mark Fleming, the chief economist of First American. He highlights that history has shown that higher mortgage rates may take steam out of higher prices, but it doesn't cause them to collapse entirely. This is especially true in today's housing market, where the demand for homes can continue to outpace supply, keeping the pressure on house prices. Now, why is that relevant? We need to take a look at house prices, and what we're seeing a rebound in home prices. It reflects on Mark's point of an ongoing market dynamic. Now, at the same time, it confounds a lot of the headlines from the fall of 2022, which call for a major correction in declining prices. So let's start taking a look at Realtor.com's listing prices. And why do we need to take a look at those? Those tend to be the first numbers that buyers see when they come to market, when they look for inventory. So there you go, there's some numbers. What we see here, you see that ramp up in 2022 when prices reached their peak in June of the year. Now, you see as the interest rates, they went down from about 5.5 in June to over 7%. Sorry, they didn't go down, they went up. About 5.5 in June to over 7% in October and November. And you see that retreat in listing prices naturally for a lot of buyers and homeowners who would have sold. Now, they signaled a major shift in the market and both homeowners and buyers pulled back. Now, as of 2023, a new leaf turned, and what we saw is a lot of buyers coming to terms with the fact that higher rates are here to stay. They still had, life circumstances that required them to ask themselves, should I continue renting or should I buy? And they have begun to return to market. In tandem with that return to returning demand, we saw prices stabilizing and then begin an upward trend. And as we move towards the midpoint of the year, what we see on this graph particularly, you see that seasonal component begin to make a very clear return. And this graph shows, list prices going all the way back to January of 2017. And you see prices tend to rise during the spring and summer months. They peak during the summer, they retreat in the fall and winter. And the next year, once again, they begin to rise towards the summer and retreat in the colder months. Now, as you see in 2022, prices rose sharply towards a June peak of 449,000. Then they retreated equally sharply over the fall and water months, only to then rebound. Now, as of June of this year, median list prices were only about 0.9% below where they were during last year's record high level. And a clear indication that our market dynamics are shifting towards that more normal seasonal pattern. Now, we do know quite well that list prices, median sale prices, tend to be a subject to fluctuation in the homes that sell every month or that come to market every month. Now, that means that in months where we have more entry-level homes, prices will tend to trend downwards, mostly because they are less expensive, more affordable. And those coming to market in months where you have larger homes, like during the summer when a lot of families tend to move or more luxury properties come to market, they can also kind of skew that median price. So for that reason, we tend to also look very carefully at repeat sale indices, or I like to anyway. Meaning indices that track the sale of the same home over time to gauge much more accurately what's happening to home values. And here we have three of them. So we've got Case-Shiller, the index, the Federal Housing Finance Agency, and CoreLogic's index. And what you see in month-over-month changes, you see the second half of 2022 retreat, and then you see that rebounding momentum in 2023. A clear indication that prices are on an upward march, much more in tandem with what would be typical in a given year. And Craig Lazar, he's the managing director of S&P. He captured this well when he was speaking of the Case-Shiller index. If I were trying to make a case that the decline in home prices that began in June 2022 had definitely ended in January 2023, April's data would bolster my argument. So he makes that case that in many respects, a price correction, which was called to be much more severe, has already taken place within the span of roughly 6 months. Now we're back with the market seeking that new normal. Now, just as importantly, seeing prices reflecting in market activity is one thing, understanding whether consumers absorb that information is another. And what you see here on this graph is data from a survey by the New York Federal Reserve Bank, where the bank asked consumers what they expect prices to be like in the next 12 months, which is the market, people in the market dictates prices. So it's very important to understand what our buyers think the market's going to do and what they expect prices to do, because that is their expectation. And what you see here, starting with September, there's a clear decline in America's expectation for home price growth. Home prices in terms of expectation went from about 4% in August all the way down to 1% in November. Yet at the same time, reflecting changing market dynamics, reflecting what consumers by and large have seen in their own communities, we saw their expectations of price growth also rebound much closer to typical seasonal change. And as far as I can see, honestly, that's good news. It means we're finding that new normal, we're finding that place where the market is going to stay for a while. So, with supply and demand part of the equation accounted for, let's look at the silver lining. Now, this brings me a lot of hope. And as I mentioned earlier, growth outlook. This is all about new construction. And we're seeing rising new construction offering a lot more options for participants in today's market. We're jumping into this topic looking at residential starts. There are homes that are having their foundations bored, that are in the early stage of construction. And in May, the latest data we saw, those homes jumped 22%, which is a significant increase, and especially so when you look at longer term trends. So when you look at that black line, it shows that in the long-term average, 1960 through 1999, we had about 1.5 million annual new home starts. Really an indication of population growth. Then you see in 2000 through 2007 period, builders really ramped up production and put up a lot of homes, which is one of the reasons that led to the housing crash of 2008, 2009. And then you see in the rod line, 2008 through 2014, the period that really highlighted the severe shortage of new construction we've experienced in this country. So for me, the good news is builders are recognising that shortage, they're recognising there's demand in the market, and they're ramping up production. Just as importantly, when you look at what type of properties builders are putting on the market, you see a real solid mix of both single family homes as well as multifamily properties. And now, just as importantly, when I look at May, the new single family component is really solid and it's seen solid growth. And what we look geographically at what's happening, we're seeing the southern region really take the lead in many ways, highlighting number one, where people are moving to, where population is growing, and just as importantly, where affordability is playing a big role in today's market. So that's all those people that are leaving California that are going to the southern states. Right, so at the same time, it's important to remember, it's one thing to start a house, it's another thing to finish it. I want to take a look at the pace of completions. What we're seeing there, once again, we're seeing growth. We're at 1.5 million annual pace as of the latest month, right in line with long-term averages over multiple decades, and a clear improvement from the last few years. Just as important, when we look at the properties coming to market, we are seeing a similar trend play out, a steady stream of single families accompanied by an equally steady stream of multifamily properties. Now, something that's much more likely to offer affordability to today's buyers in a market that's been particularly challenging on that front. Look at that dude, paragliding, there you go. Just important, we're going to look at the properties coming to market, and we're seeing a trend play out with a steady stream of single families accompanied by an equally steady stream. We just talked about that. Sorry, I got distracted by the guy in a parachute. Brilliant. So, silver lining on the map for us. I wanted to close the outlook section by just taking a look at what Doug Duncan, the chief economist of Fannie Mae, said they did a recent report, and Doug pointed out that housing prices continue to show stronger growth than what was previously expected. Now, speaking to the perception that was painted by headlines over the last 10 months versus the market reality, he also underscores that housing performance is a testimony to the strength of demographic-related demand. Now, demographic-related demand, it's kind of many layers to that onion, and this is something that I could talk about endlessly, but a lot of young people, millennials, and even Gen Z are coming to the market and embracing home ownership. They're not just eating avocado toast. And this is in the face of boomers aging in place and Gen Xers locking in historically low rates, meaning they're not likely to move anytime soon. So we've got people that have lived in houses for many, many years, 30, 40 plus years. Plus we've got people that are my age and older, the Gen Xers. I'm just a millennial, but don't tell anyone. They're locked into those 2% rates into homes that they're potentially going to stay in for a longer period of time. A typical forever home, right? So it's going to keep those levels of those types of homes difficult to find. It's going to keep them at low levels. Now, what this captures is the fact that we have a huge generation of young Americans who are between the age of 26 and 35 who are looking to buy a home coming to market in a strong financial position, ready to move forward. Now, Doug highlighted that home builders continue to add to the supply pipeline, which is important. But years of meager home building over the past business cycles simply mean that imbalance will continue, is likely to continue. And for some time, it's going to stay that way. Now, my big takeaway, Doug and the Fannie Mae research team expect housing to be supportive of the overall economy. And I think that's going to be especially true in the second half of this year. So the main takeaway, at the media point for all of us, there is some good news. Buyers are absolutely active in markets as housing is normalizing. 2, and equally importantly, in part because it speaks to a return towards health in the market, prices are rebounding. So this should offer a lot of confidence to homeowners who have been reluctant to move forward out of fear that they may have missed last year's peak and may not be able to realise a solid equity position. You will. The reality check, of course, remains affordability continues as a challenge for many homeowners or home buyers, and homeowners still have limited options for the next home because of that inventory shortage. But on the outlook, new construction is growing. That's offering us a lot of options for buyers and sellers moving into new construction that better fits their needs, and first-time buyers buying new construction to start. And with rebounding prices, homeowners are ready to move, in a more solid position. So with that, I want to just bring us kind of full circle to that topic that was touched on with confidence. Dale Carnegie captured this very well when he said, "Inaction breeds doubt and fear. Action breeds confidence and courage. And if you want to conquer fear, do not sit home and think about it. Go out and get busy." Now, certainly in the military, there's kind of a saying I learned when I was in the infantry. It's go left, go right, go middle, but just do something. And that confidence will very often carry you through and win the battle, right? Don't get bogged down is what they're getting at. And the point he's making, whenever times are uncertain, whenever periods of change occur in our lives, in the economy, real estate market, whatever, learning as much as we can, getting a grasp of what's going on around us, and data trends are important in this. We just need to take action. And it's always about staying moving and making positive decisions and moving in a direction that gets you towards your goals. Now, why is that particularly important? You might have seen this graph if you watched last month's market report, and this comes with from 1000 Watts, a PR company that has surveyed potential sellers in the market, and what they found is 65% of potential sellers were more inclined to sell their home within 6 months after speaking with an agent. So this speaks really powerfully that there is a tendency right now for people to want to come to the market. They just don't want it to go wrong and not to get the things that they need from it. So, I just want to kind of highlight that means that as we do our work, and we go, and sellers come to us, we talk to sellers, and they do begin to understand what's going on, and we can dispel those myths and that doom and gloom. Houses will become available. Right, it's important that those things we remember and we talk about. It's important that we understand that things are changing for the positive all round generally. And with the midpoint of the year and a lot of listings expiring, explore the expired listings in your market. There's people who just aren't selling. Maybe it's time to start revisiting those people. So if there's something that maybe was on the market, it didn't sell, maybe it's a good time for us to start revisiting those individuals that look to sell. And I think it's also important to understand that it's been a very kind of tough couple of years, and it's been a very tough year, the last year, for a lot of buyers and a lot of sellers. And as the market heals and goes back to a new, its new normal, it stabilizes, it's all going to become a lot more positive. And with that, I just want to leave everybody with that hopeful thought that it's going to be better, and it's going to be better soon. And in fact, this is probably the start of the wave. So if you've got any questions, please feel free to reach out. I'm always here to have a chat. All my details are going to be below this video. I really appreciate you taking the time to watch the video. I hope it's good information for you. Please feel free, to give me a call, whatever you want, if you want to discuss it in more detail. And, stay safe out there, because that's what it's all about. See ya.